Well, Ashburton as a company has been going for over 30 years, and we've not quite been investing from day one in emerging markets, but probably for a good 2 to 3 decades nearly we've been certainly putting our capital or our clients' capital into those emerging markets. Managing a fund looking at particularly China and India isn't actually that difficult from wherever you are in the world these days. For us, it makes a lot of sense managing it from Jersey, and that we're a little bit away from the noise. There's a lot of noise, short-term noise in markets. We're just a little bit away from that noise. Even in London, there's quite a lot of noise that you find there from brokers coming through, companies coming through all the time. So we can be very selective because we have offices in London about when we select to see who, what and when. But obviously the team, through technology, we're getting all instant data is the same as everybody else. And obviously the team also spend a lot of time traveling to both China and India as well. Well, as I said, the company's been doing it for the best part of 25, 30 years. My experience is roughly 20 years in China, and then obviously the rest of the team have been doing it for many years as well. So we're not all new to the region. We certainly have had a long time of getting to know the companies there and the investment staff. Yeah, very specifically, we felt many years ago, before the whole craze about BRICS and all these other acronyms were coming about, that the two emerging markets that we felt were the most diverse, and also actually were very complementary when you put them together, were China and India. I think actually from, obviously the fund was launched 10 years ago, and I think actually now, today, as we stand and look back, we think actually the choice probably was the right one. We have both those economies that have done structurally much better and economically much better than the likes of Brazil and Russia. And obviously both these economies are also a lot more diversified. They're not reliant on one income source, which is a lot of emerging markets are very reliant on commodities or oil, for example, but yet these two economies are very much more diversified. And the last point would be demographics. Obviously these are huge economies, very diversified as I said, but the demographics, certainly in India, is going to propel this economy for decades to come. So we think structural growth looks a lot better in China and India as well, and all these factors together led us to look at these two countries together.
Premiumbeat.com.
Our process and philosophy to both countries has been refined and developed over many years. That's a consequence of the equity market backdrop in both economies and the entrepreneurial culture embedded at First Round, our parent company. Consequently, we feel we're able to offer the best value proposition to our end client. So in India, for example, we view the market by taking a top-down overlay and then a very fundamental bottom-up stock selection approach. And we're able to do that because of the strong equity market culture in the country, deep and liquid financial markets, and arguably the best corporate governance in Asia. In China, conversely, the market is pretty immature, even from a developing market perspective. There are some unique characteristics in that market, so you have a strong government presence in terms of strategically important sectors being owned by state government. You have retail sentiment, which can create a lot of volatility and create artificial dislocations in the market. So China lends itself to, we believe, a very objective, disciplined and flexible approach. Consequently, we have two proprietary models that form the cornerstone of our process in that country. Have a market timing indicator which gauges the underlying health of the market, and that determines our capital allocation. And once that equity level is decided, we have a stock selection model that populates the portfolio. So the outcome of that process and philosophy in each country is a high conviction mandate of 20 to 30 stocks in each country. Its performance over since launch and against peers is pretty respectable. We are first quartile on a year-to-date 1, 2 and 3-year basis versus peers, and the fund has returned plus 28.3% since launch versus the MSCI Emerging Markets Index, which is down 2.6%.
Any difficulties? I think investing particularly in some of the China indices where perhaps corporate governance, perhaps the rule of law, regulation isn't quite so entrenched as we see elsewhere in the world. We have to spend a great deal of time trying to get our heads around the systems of governance, what's going on with corporate governance within the companies, and that's taken quite a lot of learning, I have to say, over the years, and it's made us to look at each of those markets slightly differently. There's things we can do in one market that we simply cannot do in another one. So I think, all in all, it has been a bit of an experience, particularly having the global financial crisis happening right in the middle of it as well. So it's been an up and down time, but I think we're managing the fund today with all that experience a lot better, than as best as we possibly can.
Premiumbeat.com.
The fund managers are always looking to conscientiously see if we can deliver more value to the end client. A good example of this is post the financial crisis, where we initiated a series of changes to the portfolio. We brought in some maximum and minimum country tolerance levels of 60% and 40% to provide a more balanced offering. We slimmed down the number of holdings from 60 to 80 names to 40 to 60 names to provide more concentration and higher conviction. And we've also brought liquidity to the forefront of our thinking. In China, for example, we only screen the MSCI China universe. This covers about 85% of the equity market by market cap. And that gives the portfolio managers an extra layer of comfort with the rigor and data transparency when we're screening for stocks.
I think the future of both of those is very different, but both of those economies. China's obviously going on a massive shift, a huge amount of change. It's gone from this low-cost exporting giant that we all know today, and they're trying to now change their business model to a more service-orientated, domestic-orientated growth model. And with all change comes disruption and uncertainty. So there is a bit of uncertainty with China because that growth slowdown that's resulting because of that change in policy is causing tensions both domestically and obviously internationally. That's going to continue for some time longer. I think the India story is a little bit easier. It's obviously decades behind China from a growth perspective, from a per capita income perspective. So India's still got a lot more to go on the growth sort of catch up. And Indian demographics are far superior to Chinese demographics today. So I think the growth story in India is a lot easier to get your head around and a lot easier to project than it is for China. But ultimately, both economies are still have some very profound and very radical changes going on, which is propelling new sectors ahead. So technology, we all now know about Alibaba, Baidu, a lot of these Chinese tech giants which are dominating in China, which are thinking about branching out to the world. And we think a lot of those Chinese technology companies perhaps won't do brilliantly in developed markets, but in other emerging markets where they're more relevant, we think that they could be game changers in some of those markets, including India. So India is again a little bit further behind China in some of these areas. But again, most of these economies, I think, will do really well, both China and India, in other emerging markets, and that's a really important point.
So in China, we're going to see a country that's no longer singularly defined by ferocious growth levels like we've seen over the past couple of decades. Going forward, we see various types of constraints, be it economic, political or social, being imposed, if you like, on the economy, and consequently fairly formidable challenges for Beijing for the next decade. Our recent presentations have been focusing on the economic variety, particularly around debt, the currency and property prices. Our key sort of takeaway really is that debt at the government level and the household level remain moderate on a cross-country comparison basis, relatively well contained, but private sector debt to GDP has certainly risen to levels consistent with financial crises when looking back at history. In terms of the currency, we think a one-off devaluation is probably warranted, but as it stands today, Beijing will not be engaging in that policy. As for property, some of the smaller developers with more leveraged balance sheets are going to be under pressure from the recent devaluation, and we could see some stress there. Our summary really is that Beijing has both the political will and the financial ammunition to avoid the worst case scenario, but periods of economic turbulence and stability are to be expected. On the flip side of that, we have extremely strong structural tailwinds in the form of a rising middle class, strong household consumption, and the development of the capital markets to fund corporate China going forward, which will also affect, we hope, technological breakthroughs and innovation, and that will be a huge net positive for China. So we think the performance of China and India going forward over the next decade will hopefully map the past one. We see both economies benefiting from a much more sustainable growth path of consumption and investment, and each economy benefiting from what it needs most. China through consumption, India through investment. That, along with what we see as decisive government, a strong reform mandate that focuses on what each country needs most, and strong underlying tailwinds, offers a very compelling opportunity for investors going forward. So we strongly believe any client willing and able to take the appropriate level of risk should have exposure to both these countries within their portfolio.